Yes, I think we should all be humbled by the surprise, and we also have to take into account the uncertainty of war. I know there's lots of talk in markets that, geopolitical events, markets recover quickly, risk assets recover quickly. That is true, but that assumes there's no systemic shock, and that assumes that you get clarity fairly quickly on the outcome of the geopolitical event. I think both things are still not certain at this stage.
Elliot, there's been a lot of focus on SWIFT or not SWIFT as one of the sanctions as well. But as Joe Biden was pointing out, if you shut the Russians effectively out of dollar transactions, why would you need to cut them out of SWIFT as well? Would you concur that that's actually the case? And if so, what are the ramifications not only for Russia, but for broader Europe and broader commodities and the financing of those?
Yeah, I think the first thing to recognize is that the point of sanctions is not to change Russian course of action. I think everybody realizes that will be determined by military and geopolitical drivers. The second point is the sanctions. Really, it's you want to inflict pain without destabilizing the financial system broadly. The cutting out of SWIFT does not mean you shut them out of financial services or financial systems. So there's two parts of the equation. One is you basically have to de-link their access, shut down correspondent banking system, exclude them from participation in US dollar system. And then SWIFT is just the messaging system that sits on top of that. Both of those actions are highly destabilizing. So, we should expect continued volatility coming out of just simply the sanctions talk as well in the coming days.
Elliot, what about the actions of central banks then at this stage? Because as we watch this story unfold, we were in the middle of what we thought was going to be a protracted rate hiking cycle for the rest of this year. Do we take that off the table now?
Well, there's going to be a stagflationary impulse from the war, but that's almost like a wind. It's going to hit the neighboring countries hardest, and by the time it crosses the Atlantic, it'll fade quite a bit. So I think that it's a tale of two worlds. The U.S., the hiking cycle, I think, cannot be stopped. It will be slowed down. It will be flattened, perhaps stretched out. The Fed can maybe take it a little bit more time. But in Europe, it probably has changed course. It's hard to see. I mean, you just had the Eurogroup finance minister speaking, but even the most optimistic scenarios, this is going to add to European inflation. It's going to cut into European growth. And that means that the ECB discussions from 4 weeks ago are already a bit outdated. They're on a new path now.
Can I ask you quickly what that means for policy action, as Europe is saying this morning that it thinks it can protect most of the bloc from some of these inflationary pressures? That was the line that was crossing from Germany.
They cannot. You cannot. If energy prices go up, if commodity prices go up, agricultural prices go up, that is inflation. You cannot protect from inflation. I think what they meant is they can protect households and household balance sheets from inflation, but somebody has to pay the cost. And that just means the sovereign will step it up fiscally. There'll be fiscal support to households. The voter may be protected, but the economy will not. So somebody's going to pull back. If, at a minimum, it'll hit consumer confidence just to see the price sticker shock, even if they know there'll be some government support to buffer it a little bit. We don't think this doesn't mean a recession in Europe. By no means. We think even if the conflict gets worse, this does not trigger a recession, but it does mean it cuts into growth. And it does elevate inflation beyond what we were expecting 3-4 weeks ago.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.